Welcome into a daily editorial here on the KE Report. In this daily editorial, I am talking portfolio management for resource investors with Jordan Roy-Byrne. Jordan is the founder and editor of the Daily Gold. Jordan, I get your newsletter, and I very much appreciate reading over your company coverage, but also your technicals for the metals and also comparing the metals to a number of different markets. But when I consistently read over your model portfolio, you have some rules that I think should be noted by investors for this sector. I think we've all experienced that where we've had a stock that runs up and then I think we hold on to too much of it, don't take enough winnings off the table and get a bit of a cash position to reallocate that money. Let's first talk about some of the winners, some of your rules around stocks that start to run for you.
Well, the main rule, you said it, Corey, is taking money off the table. And I think, look, it's different for every person. For one investor, it might mean when the stock doubles, I'm going to sell 50%. For another person, it might mean, well, if the stock goes up 250%, that I'm going to sell 20 or 30%. So it's really for the listeners, they can fit these rules into their own expectations and goals, because every investor has different goals, expectations, risk tolerance, time horizon, etc. But yes, that's a very important thing with winners is take some money off the table. I term it trimming the position. And look, this sounds really good because of the market we've been in the last couple of years, where here and there we've seen more than a few juniors have made really big sudden moves only to come back down and give up most of those gains. And so it in the kind of market that we've been in, it makes a lot of sense. Now, assuming over the next, let's say 12 to 18 months or 12 to 24 months, we get this big breakout move, then things are going to move up considerably. But that being said, Corey, even in that kind of a market, when you still see stocks making huge moves, you still want to, at some point, sell, trim the position, lock in some gains, and then, as you said, take that capital and go put it to use in something that may have a better risk reward. And with respect to these companies, there's no hard rules as to know when to do that. It's very difficult because it might be the right idea if for a certain stock if it goes up 100%, but then with something else, you don't want to sell it too early. So, a lot of people talk about if it goes up 100%, take half your money off the table. I don't necessarily agree with that unless it's it's a real gambling type position. So the more risky it is, the more gambling it seems like, with respect to tiny juniors and focused on drill results and things of that nature. That would be a case where you'd want to, and especially if something pops up and it's not really on fundamental news, it's more on market speculation. That's another reason you would be tempted to trim the position and take some gains off the table. So overall, I think the main point here is people always talk about letting your winners run, and that's true. But if you trim the position, you can continue to let your winners run. So you just need to figure out what's best for your own portfolio. Maybe it's selling half at a certain point, maybe it's selling a third. I like to sell a third. And Corey, this is a great rule because I've learned through my own failures in the past. Even just in the last couple of years, I can count more than a couple of times where I had a stock that did really well. I didn't trim the position or I didn't trim it enough, and then it ended up correcting 50 or 60%. So, overall, look, stock picking is important, but in this kind of a sector where we don't see gains sustained over long periods of time, it is crucial to trim your winners at some point, because if you don't, you're going to be riding them way up, and then you'll ride them not all the way back down, but you'll see your gains just disappear.
Hey, hopefully not all the way back down, but I'm sure there are some people out there. I'm even guilty of that, holding a stock that has run and then you watch it run the whole way back down to where it started and you just feel like you left all that money on the table. But there is this balance, right? Even as you said, some people go by the rule that if it has gone up 100%, they trim half their position and then they're essentially riding it out for free. I think a bit more analysis needs to be done. When a stock does, let's say, double, I think you absolutely should be selling some of your position, but you should also be looking at the balance of what the market has done and if that stock has outperformed and why it has outperformed. Get a feeling for what news is coming down the line, because sometimes it's a simple thing is companies need to go quiet for a while, either because they're in the middle of an economic study or, quite frankly, they just can't get onto their property due to weather conditions. It really needs to be done on a case-by-case basis. And as you said, take some money off the table, but don't necessarily stick by a hard and fast rule. You have a comment there?
Absolutely. I mean, I think you made great points, and that's why it's hard to button down and say, oh, well, with this particular, I mean, in this situation, you want to sell this much and you sell it when you reach this percent, this amount of a gain. There's just so many different factors to consider. But as you were saying, you really need to look closely at the situation, why the stock is rising. Is there a new positive fundamental development? I mean, has it gone up a lot because basically of marketing and then speculation? What kind of news does the company have coming to support the price? Because a lot of times what happens is you might see a company report great news and then the stock really runs and moves for 3, 4, 5 months after that. And, they raise money and then, you might be up a lot on the position, but then you have to think, okay, who is going to continue to buy the stock? Why is it going to continue to rise from here? Are metals prices going to continue to go up? Is fundamental news coming? Or maybe in the case of none of those things happening, you could see over the next quarter or two, the stock could correct and come off quite a bit just because there's no news coming. The market's not that strong. There's no new buyers. So there's so many different factors to consider. And that's why you can't really stick to a certain hard and fast rule. I mean, I like selling a third personally because maybe if you sell it too soon, you still own 2/3. But generally, here's one thing to consider. With one thing you could do with looking at, how much the position can rise over time. It's if you're going to sell maybe even like a quarter of it or a third, it's okay to do that early on because you're still locking in some gains, taking that money off the table versus, I mean, if something has already run 3, 4, 500%, then that would probably be the point in time where you'd want to sell half. So that's something to keep in mind. But as you were saying, Corey, there's no hard and fast rules here. There's so many different factors that go into it. There's so many different companies. It's just, I mean, we could literally do, hours worth of material on here talking about every certain situation. But just keep in mind that there's many different variables here. There's many different companies and situations, and keep all those things in mind. But best thing, sit down, really figure out what your goals are, your risk tolerance, and then after you understand and know what those things are for your own portfolio, then you can come up with some not hard and fast rules, but just a simple rule where, okay, maybe if it goes up 100%, I'm going to sell a third. Maybe if it goes up 200 or 300%, I'm going to sell half. Something like that, because over time you're going to keep more of your gains that way, and it also helps you reduce the risk because you're taking money and you're putting it in cash, and then you're going to put that money basically in better opportunities versus that money being in something that is not as good of a value as it was, much earlier when the price was much lower.
Yeah, that makes total sense. Constantly be reevaluating. One trick that I also do, being the accountant that I am and kind of liking to look through financial statements, I know that sounds weird, is when a stock does run up, go to the warrants and options section and make sure that there isn't a huge overhang of warrants or options that are underneath the current price that are expiring very soon. Yeah, I can't tell you how many times I've seen stocks coincidentally run up right before warrants or options expire, and then all them get exercised, and the stock drop back down. So that's just another side note to take note of. But Jordan, when it comes to weighting in a certain portfolio, you actually outline to your subscribers how much a certain stock is weighted in your overall portfolio. That's another factor to pay attention to, isn't it?
Yes, it is. And the way I would think about weighting, and again, because we probably have you probably in our audience, I should say, there's a wide range of risk tolerances and goals. And so someone might be comfortable if a stock is 10 or 15% of their gold portfolio. Someone might be really uncomfortable, and they might they might want to have 20 or 30 stocks and everything be 4 or 5%. So but the general rules that I try and stick to and think are applicable to everyone out there, your favorite stocks and the ones you're most confident in, those should be your largest positions. Now, the ones that are more risky, where there's more uncertainty, and if they have a good drill result or if they really discover something, they could go up 5, 10, or 20 times. Those are the types of things where, for me, I would, I like to look at a full position starting out as 5 or 6%. If something's a half position, it's 2 or 3. So if something is like, let's just say it's more of a penny junior, it's a drill play. It's tiny. If it's successful, it's going to be a big winner. But they don't have anything yet, so it's really not worth anything, and it's risky in that way. Something like that, I would look at as a half position, 2 or 3% starting out. Whereas maybe something you're comfortable with, you're somewhat optimistic on, is just a basic average position. I look at those at 5 or 6%. But ultimately, if it's something that you're really optimistic on and you want it to be one of your largest positions, then you can do a couple. You don't just have to buy that once. I would, in other words, if you want something to be a 7, 8, or 9 or 10% position, I would space that out over 2 or 3 buys. I want to just suddenly go in and take 8% of my portfolio and buy it right there. I would space it out over a couple buys. So yeah, generally speaking, the things to remember here, if it's one of your favorite positions, you're really optimistic on it, that should be your, basically, in other words, overweight the positions you're most confident in. And secondly, the positions that are more risky but offer the highest potential, those should be at the bottom of your portfolio and weighted, lesser than most of your positions. But Corey, these things are so important because, why, if you have everything balanced out and you have 15 or 17 or 20 stocks in your portfolio, why would your 15th best or favorite position be weighted as much as your top 2 or 3? It doesn't make any sense. So remember, overweight the positions that you're most confident in. And, when those do really well, then you can trim, and they become too large as a percentage of portfolio, then you can trim those bit by bit. But again, these are things that have helped me, and I hope they help the listeners out there.
Yeah, the fact of the matter is this is a risky industry and sector to invest in. So by doing your due diligence, finding out the companies that you think have the best story, and sometimes the best story includes having the least amount of downside, then there's absolutely no reason why you shouldn't be overweight in those stocks compared to some of those maybe 10 baggers that you're searching for that, in all fairness, also have the possibility of going pretty much down to zero and you getting rolled out of your position. Let's also talk about kind of the downside. Some of the stocks maybe that you're sitting on a loss, you still think that they have either money in the bank and a drill program underway. How do you balance out your losses, trying to limit them, but then also understanding that, hey, sometimes you do have to take some losses to get some gains?
Right. Well, I like to use generally a 20% rule. Now, if a position, it also depends on the size of the position. Because generally speaking, if a position is 5% of your portfolio and you use a mental stop loss of 20%, you're basically limiting your risk on that position to only 1% of the entire portfolio. Now, it's important to note here, I'm just talking about a 20% loss from where you bought it. I'm not talking about the stock goes up 100% and then it goes down 20% and then you dump it then. I'm talking about your cost basis. From your cost basis, you should never take more than a 20% loss. Now, if you listen to the real experts out there, the real people who've been successful trading over time, I mean, we're talking about these hedge fund guys who make billions and billions. The number one thing they always say, cut your losses, don't lose money. And Corey, I mean, I've been employing the 20% rule for, I mean, five or 6 years, maybe a little bit longer than that. There's only one time it really hurt me, and that was I bought something in December 2015. It went down 20%, and obviously then we had a historic bottom in January 2016, and that thing ended up tripling or quadrupling. So only one time it's burned me, and so it's when if you get into a real bull market, it might burn you again because things can correct 20 or 30%, and then they can, rebound and go to new highs after that. But another way to look at this is when you're trying to figure out where to buy a stock, I mean, look at it, and if it's something that, and again, I mean, this is more of an art than a science, but if it's something that has a risk of going down 20%, maybe you stand aside and you wait for that to consolidate or correct more before jumping in. So, I mean, that's another thing to keep in mind with the buying side of it is you don't want to just rush into something if it looks like it could correct 20 or 30%. Maybe it's a stock you really like, but it's already gone up quite a bit, and so it could correct at 20 or 30% at any time. That's something where you probably want to step aside and wait for that to consolidate and correct. You might have another chance to buy that later. It's better to buy something else. Now, if something like that has gone up a huge amount, but you really feel the need that you really want to get in, it's going to keep going up, do tiny buys. Like instead of doing a half buy or a 5% buy, do a 1 or 2% buy just to dip your toes in. And so, that way, if it goes down 20 or 30%, it hasn't affected your portfolio that much, and then you can buy another 2 or 3% and build your position at a lower cost basis. So I know I'm getting a little bit off track from the 20%, but to sum it up, Corey, basically, most of the time, look, if you don't have really bad entry points, then this 20% rule is not going to hurt you. I mean, generally we see with juniors, if they go down 20%, there's a higher risk they're going to go down 30, 40%. And then if that happens, there's a risk it could go down even more after that. So it's just, look, the stocks that are going to be 5 or 10 baggers for you, it's very unlikely that they're going to start out and be big losers and then from that point turn into these massive winners. I mean, look, it could happen, but it's probably not going to happen. If it does, it can take many years for that to turn around and happen. So, I mean, look, no rule is going to be 100% foolproof, but cutting your losers is so important. And, I mean, that's something I really try and stick to. And it would have saved people a lot of money during the bear market. And finally, I would just say on the buying side, just be careful and ask yourself, is this something that could go down 20% from here? And if it is, then you probably want to hold off or only buy a 1 or 2% position and scale in very small amounts.
Yeah, I think really what it comes down to, too, is don't get married to any certain position or any certain stock. Always be reevaluating and always be asking the tough questions to management. I know Jordan and I have covered quite a number of different topics here in terms of what to look at and how to manage your portfolio. If anybody has any other comments or suggestions, maybe what they do in their portfolio that has worked, and even those strategies that haven't worked, please be sure to share them in the comment section. And I'm always happy to hear from everybody. You can email me, fleck@kereport.com, and maybe we'll pick this conversation up in another couple of months and recalibrate some of the comments that we get. Jordan, thanks for your time today, and thanks for sharing some of the insights on how you manage your portfolio.